All right, so next we go to chapter 5, gross income and exclusions. So here we delve a little deeper into what we discussed in chapter 4. Whoa, excuse me. Overshot the runway. All right, so first they talk about realization and recognition of income. Again, we did discuss this in chapter 4. So as they point out, gross income is income that taxpayers realize, they recognize, and report it on their tax return for the year. And so this goes a little deeper into that. And of course, as we indicated in chapter 4, income that's excluded or deferred is not included in gross income. And of course, as we talked about, excluded income such as interest on municipal bonds is never taxed, whereas like like-kind exchanges are deferred, as are installment sales until a later time, a later year. And so they dive into the Internal Revenue Code. Section 61 deals with gross income. 61A defines gross income as all income from whatever source derived. And like I mentioned in the last chapter's lecture, from wherever derived, if you are required to report your income as a U.S. citizen. Note here in regulation section 1.61a, the related regulation section that relates back to section 61a, says that it includes income realized in any form, whether in money, property, or services. And so that's key right there. You don't have to receive cash in order for you to realize and recognize and report as gross income on your tax return. You can exchange property, one property for another, and if it's not like kind, it won't be deferred. You have to you've realized and recognized that new property, and so you have to report the fair value as income. And so you recognize gross income when you receive an economic benefit, you realize the income, and the tax law does not provide any exclusion or deferral on that income. So what's an economic benefit? Well, you receive something of value. And so the most common type of economic benefit is compensation for services, proceeds from property sales, and income from investments or business activities. Now, do you receive an economic benefit when you apply and receive funds from a loan? Well, I guess technically you do, but you have to pay it back. So you have a liability, not gross income. It's a wash. You're receiving a benefit, but you gotta pay the benefit back. So for that reason, loans are not considered income. Realization principle. recall that you have to engage in a transaction with another party when you do that transactions, if it's um, an arm's length transaction between two unrelated parties, that transaction results in a measurable change in property rights. In other words, if it's an arm's length transaction, you're bargaining with the other party for whatever it is you're getting, and uh, you're not going to in an arm's length transaction, for instance, take less than fair value, what you feel is fair value for, let's say, stock you own. You're going to want to get uh, pretty close to fair market value. And so uh, there you have the measurable exchange. You're getting cash, or and again, it doesn't have to be cash. It can be other property. It could be services received, but usually it's cash. So there's that measurable change. And again, realized income is recognized income unless there is a specific deferral or exclusion provision in the Internal Revenue Code that keeps it from being recognized. So again, the form of receipt does not matter. You don't have to receive cash. People who barter, they exchange one service. Let's say they're good in plumbing and they need some dental work, so they go to a dentist who is willing to provide dental work in exchange for plumbing services. Um, just because the parties are not, one party doesn't receive cash does not mean that income has not been realized and recognized. Now, what happens if you're selling property, and property broadly could be uh, dirt with structures on it, could be stock, could be a car, could be, categorized as either real property or personal property, right? So, what if you are selling property that you previously purchased or were gifted or inherited? Well, that property has a tax basis. Now, what that tax basis is depends on how you obtain the property. Most often, you would obtain it through purchase. So your purchase price would be what's called the tax basis. So the question is, do you get to recover the cost of your purchase of that asset when you turn around and sell it? Well, the IRS originally took the stance that no, they don't get to recover their cost of buying the asset when they sell it. So the whole amount received in the sale, in the eyes of the IRS, was taxable. Well, the courts disagreed with them, and so essentially we have this return of capital principle that says that when you sell a piece of property, when you sell property, you get to deduct the cost of that property when you're calculating realized income. You also get to deduct selling expenses. Why? Because you put money into this. Now, again, you still have a basis when you receive something, a piece of property by gift or by inheritance. And essentially, you take the basis of the person giving, and in the case of inheritance, you take the fair market value as your basis. The fair market value of the property at the time you receive the inheritance. So still have a basis. It's might be a different amount though than what you would have paid for it though. And so if you look at page 13 of chapter 5, exhibit 5-2, there you have the formula for calculating gain or loss from the sale of an asset. So we'll talk about that when we get to it. So the question also arises as to when you recognize income. For individuals who are on a cash basis accounting, as most individuals are, you recognize income when you receive it or receive it or constructively receive it. Well, everybody knows what actually receives means. The question is, what does constructive receipt mean? Well, it means that you constructively receive income when it's been credited to your account, you the taxpayer, or when the income's unconditionally available to the taxpayer. The taxpayer's aware of the income's availability, and there are no restrictions on the taxpayer's control over the income. So, for instance, if you were to receive a check at the end of the year, and most of this stuff arises at the end of the year. And so, if you had a bonus coming to you, a bonus check from your employer, and you tell the employer, well, just hold on to that till next year. Well, has that been constructively received? And the answer is yes, because it's unconditionally available to the taxpayer. He's aware of the income's availability, and there's no restrictions on the taxpayer's control. So even though he's wanting to wait to receive that check because all those three requirements are met, that person has to realize and recognize that income in the year it was constructively received, not the following year. Well, what happens if your employer gives you a check and says at the end of the year and says, hold on to it, we're expecting some funds in right after the first of the year, but we don't have enough to cover the check? Well, in that case, there's a restriction on the taxpayer's control, and so that would not be constructive receipt. Now understand, back to accounting methods. For individuals, you for the most part, you don't have to worry about constructive receipt. It's the actual receipt of funds that you're getting. And so for individuals, most individuals are on the cash method. You don't have to realize and recognize income until you actually receive the cash. Again, if you're receiving property for property or services for property or property for services, this doesn't apply because you still have to realize and recognize income even though you're not receiving cash. But where you're receiving cash and you're on the cash method, you don't have to realize and recognize cash until you actually receive it. Well, corporations are on the accrual method of accounting. And the other thing, back to individuals, is they can't recognize an expense until they pay it if they're on the cash method. Okay, on to corporations. Corporations are invariably on the accrual method of accounting for both accounting purposes as well as tax accounting purposes. And so they recognize income when it's earned, and they realize an expense. Well, they recognize an expense when it's realized. In other words, when it's accrued, when they get the bill, in other words, not when they actually pay the bill. Question arises sometimes as to who recognizes the income. And so this comes about, part of tax strategies is trying to possibly shift income to individuals, usually family members who are in a lower tax bracket. How convenient would it be if you're in a higher tax bracket to say, well, don't pay, say to your employer, don't pay me, pay my son who is in the 10% tax bracket. You would be able to shift income to your son in the lower tax bracket. And so this income shifting strategy, the IRS is well aware of. And so essentially you have what's called the fruit of the tree doctrine, meaning, and I think they call it something else, the assignment of income doctrine is what they call it, that says that the income must be earned by or reported by those earning it. Which makes total sense, right? Well, what about income you receive from property? Let's say you receive dividends, or you own rental property and you're receiving rent revenue. How can you shift income there? Well, you can. There's a way to do it, but the way to do it is to transfer the property to the one you want to receive the income. You want your son to receive dividends on the stock you own? Well, gift it to your son or sell it to them. And most control freaks don't want to do that, of course, so that's why you run into this assignment of income problem. Understand And there are certain states where you have what are called community property systems. Oregon is not one of them, but Washington is, Arizona is, California is, and Texas. Idaho is as well. So in community property states, uh, and if you're married, let's say husband works, wife is stay at home, or vice versa. So one earns the income, the other doesn't. In a community property state, the the one who, well, in a common law state, the one who earns the income has that income attributed to them. Whereas in a community property state, both parties earn the income because they're married and they're living in a community property state. So one half of the husband's income would be attributable to the wife. Well, if you're filing joint returns, does it really matter? No, the answer is definitely no, because you both are liable for the tax debt on the whole income. Where it does matter is where the parties are married and they're married filing separate. That you could run into that problem. If you're in a community property state, you've got to report half your spouse's income. All right, so here's that assignment of income doctrine and all that stuff. So to shift income from property to another person, you've got to transfer ownership of the property to the other person. Now, if a spouse brings in property into the marriage that they keep separate, that was their separate property, it remains separate property in the marriage as long as they don't commingle it with other community property or make some outward um, expression that it's community property. So as long as they keep it separate property, any income earned on that separate property is attributable to the spouse that owns it. And so income from services, whether you're self-employed, independent contractor, or you're employed by someone else, is called earned income. Because you generate that income by your efforts. Income from property is called unearned income. Now, how that's taxed depends on the type of property. And so, you know, you have sale of real property, you have dividends that you receive on stock you own, you might have a loan out where you receive interest income, you might own rental property where you receive rental income. You might have, for instance, a trademark or patent where you're receiving royalty payments, or you might have an annuity. So some of these things are taxed differently than others. So it depends on the type of property, um, how it's taxed. We really don't talk about annuities. I purposely skip it. As a matter of fact, I skip some other stuff in this chapter as well. You can't cover everything. All right, so we talked about property dispositions and the return of capital principle or doctrine. And so when you sell property, you get to recover your basis in that property that you're selling. You also get to deduct selling expenses from the sales proceeds. And so this is the basic formula for calculating gain or loss on the sale of an asset. Sales proceeds less selling expenses equals the amount realized from the sale, and then from the amount realized you subtract the basis in the property that you're selling to come up with your gain or loss on the sale. Now again, the rate at which the taxpayer is taxed on those gains depends on whether they use the asset for business purposes, investment purposes, or personal purposes. Also, the extent to which they can deduct losses from this property disposition depends on those things as well. So we talked about that last chapter somewhat. We will talk about it in the future. Now next they talk about other sources of gross income, which is income other than wages or business and property. And so what happens when you own an interest in a partnership or what they call an S corporation, which is taxed like a partnership? Well, that's considered a flow-through entity, and the owners, the partners or shareholders in the S corp, they receive what's called a K-1, which itemizes the income and deductions from the flow-through entity that is attributable to the partners or shareholders. And so as they note here, the legal form of the business affects how the income generated by the business is taxed. If the business that you have an ownership interest in is a C corporation, then that is a separate taxable entity, tax-paying entity, separate from its shareholders. If it's an S corp or a partnership, the partnership and S corp must file a return for information purposes, but then the income and deductions flow through to the partners or shareholders of the S corp, and they report the income and deductions of the entity on their returns. They're separate returns. 1040. Alimony, we talked about this last chapter just briefly. For divorce decrees that occur before, I believe it's January 1, 2018, the transfer of cash made under a written separation or divorce decree, separation agreement or divorce decree, as long as it's designated as alimony and not something else, and the spouses do not live together when that alimony payment's made, and the payments cannot continue after the death of the recipient, then in that case, the alimony is deductible to the payor. It's taxable income to the payee, the recipient of the payment, alimony payment. Now, for divorce or separation agreements executed after 2018, it's just the opposite. Alimony is not deductible. Alimony paid is not deductible by the payor, and the payee, the one receiving the alimony payment, does not have to include it in their income. Why did Congress do that? I have no clue. I think I've opined that under the previous law, where alimony was deductible by the payee, or excuse me, the payor, I just theorized that there was some congressman who was going through a divorce and wanted to be able to deduct the alimony payments, so they created this law for their benefit. So there you go. That's why I think the law was the way it was previously. But to be quite honest with you, I think the law in its current state after 2018 is how it should be. Prizes, awards, and gambling winnings. The general rule is that prizes, awards, and gambling winnings, you win the lottery, you play the slots and hit it big, are included in gross income. Makes sense, right? The only prizes and awards excluded are pretty narrow. So if you receive a scientific, literary, or charitable achievement award, you can exclude it from gross income, but only if the recipient is not required to render substantial future services as a condition for receiving the prize or award. The recipient was selected without any action on their part, and the payer transfers the prize or award to a federal, state, or local governmental unit or qualified charity designated by the taxpayer. So if the taxpayer receives the award and turns around and gives it to the charity, the taxpayer is going to have to include it in their income. And of course, they'll get if it's a qualified charity or governmental unit, then they're going to be able to deduct at least some portion of that as a charitable contribution. But if they designate that it go to this governmental unit or charitable qualified charity before they receive it, and it goes directly to that unit or charity, then they don't have to recognize it in income. The second exception deals with awards for length of service or safety achievement. The exception is limited to $400 of tangible property per employee per year. Think of a watch that an employee receives upon retirement from their company. Well, if it's a Rolex, a real Rolex, that's probably going to be worth more than $400. That excess is going to be income to that employee, the excess over $400. The other thing is that the tangible property has to be other than cash, cash equivalents, gift cards, gift coupons, or gift certificates, or vacations, meals, lodging, tickets to theater or sporting events, stocks, bonds, other securities, and other similar items. So if you get any of those items as an employee for a length of service or some safety achievement, then all of it would be taxable income. The next exception to the general rule concerning prizes, awards, and prizes and awards, really, is prize money received by Team USA athletes from the U.S. Olympic Committee that's being received on account of their competition in either Olympic or Paralympic games. Now, this third exception does not apply to millionaire basketball players whose AGI exceeds $1 million if they're filing jointly. If it's married filing separately or single, then they're limited to $500,000. So, millionaire basketball players, this doesn't apply to. Social Security benefits, briefly, we're not going to go into the calculation of this, but just know that how much Social Security benefits is taxable depends on your filing status as well as the amount of the taxpayer's what they call modified adjusted gross income plus 50% of their Social Security benefits. And so the Social Security benefits can be taxable anywhere from not being taxed at all if your modified AGI is plus 50% of your Social Security benefits is less than or equal to $25,000 if you're single, $32,000 if you're married filing jointly. And then there's a different rule if you're filing married filing separate. Bottom line is, and it escalates. If, for instance, if you're single, give can be 50%, all the way up to 85%. So go ahead and look at that. If you happen to get you won't get a problem on this. You may get a question about this on the quiz. If you do, just send me an email. If you get it right, maybe I'll give you bonus points. If you get it wrong, I'll add back 2 points. You can receive what's called imputed income when you receive indirect economic benefits. And so these come from things like employee discounts or low interest loans with the company you work for. So for low interest loans, the amount would be the amount of imputed income is the difference between the loan amount or loan percentage, interest rate percentage you're receiving versus what your average customer would receive. For bargain purchases, the tax consequences vary based upon the relationship between the parties. And so if it's an employee-employer relationship, so the employee is receiving some sort of discount, the general rule is that it's taxable compensation to the employee. If there's a bargain purchase between a shareholder and the corporation that they own shares in, that results in a taxable dividend. So the bargain purchase by the employee would be taxed at normal rates, ordinary income rates, whereas for a bargain purchase by a shareholder would be taxed at dividend rates. And last but not least, if you have a bargain purchase between family members, well, the difference between the fair market value and the actual purchase price would be considered a gift by the seller to the buyer. And a note here back on loans, if the bargain loan is less than $10,000 or $10,000 or less between the lender and borrower, this imputed interest rule does not apply. This may come as a bit of a shock to you. And it can quite often catch people by surprise. Let's say you stiff a credit card company for $5,000 that you owe them. And then all of a sudden, you receive a 1099 forgiveness of debt income statement from them. Oh, and they've also sent a copy to the IRS as they're required. So they're saying, okay, you stiffed us on this $5,000, but and we've forgiven the debt, but we've reported it to the IRS as forgiveness of debt income on your behalf. Well, lo and behold, you have to report that as forgiveness of debt income unless, and the unless is if you are insolvent both before and after the debt forgiveness, then you do not have to report this as income. And so in the book, well, I mean, if you borrowed $100,000 and you're insolvent by $300,000 and they forgive the $100,000 loan, you're still $200,000 insolvent, so you're insolvent before and after. But the one they use in the book is an example where after the discharge of indebtedness, the taxpayer is partially solvent. And so in that case, where the discharge of indebtedness makes the taxpayer solvent, the taxpayer recognizes gross income to the extent of their solvency. And so if a taxpayer, the example in the book is if a taxpayer is discharged of $30,000 debt and this causes him to be solvent by $10,000 after the debt relief, the taxpayer must include $10,000 in gross income. So what do you have to do? I mean, the IRS is getting the 1099 forgiveness of debt income, and if you don't report it on your tax return as income because you're solvent or you're insolvent both before and after the discharge of debt, how do you prove that to the IRS? Well, basically they'll send you a proposed change in your return and say, hey, you forgot this, and you have to send them proof via basically a balance sheet of your assets and liabilities showing that you're still insolvent after the discharge of this debt. All right, we talked about exclusions earlier. So I'm going to take a brief break and we'll get back on this in a second.